Dan Kaufman, if you could take a few minutes here and just give us a summary.
Sure. Thank you, Sal. Thank you for the Knowledge Group and everyone for participating today. I think my key takeaway for the sections we covered is really as compared to past years, it's been a relatively quiet year from the proxy advisor front in terms of shifting policies. While there were a few tweaks or items that came into play this year, overall ISS and Glass Lewis stayed relatively consistent with how they evaluate CEO pay and some of their other policies. Where you really do see more of the conversations, as Jim mentioned and were in some of my slides, is really the discussions around ESG and BlackRock's letter, and are there other items that need to come in that haven't historically been considered or discussed within compensation committees within their meetings, and really expanding what they look at not only within ESG stuff, but also looking down the organization at deeper pay levels and diversity amongst a broader employee base. But beyond that, really not a lot of items within proxy advisors. And then you'll see, as we just talked about, a few additional disclosure around director pay, and then continuing disclosure on CEO pay ratio, which we would not expect to get much discussion this year, as it hasn't really since the initial year of disclosure.
And thank you for that, Dan. Jim Dickinson, would you care to take a few minutes here to sum up with your key takeaways, things you'd like to leave the audience as top of mind?
So what I'll do is I'll have some recap that is things that are, we feel a little bit stronger about that are likely to occur, and some that are just sort of a little more long range forecasts that could be true, could be something that we don't see pan out. The first one is one of the latter category. We might see the 2020s as the decade when proxy advisors focus on the absolute quantum of pay for executives. As I mentioned, we saw that sort of trend in the proxy advisors look at things. They went from just mostly looking at practices, I should say, to looking at a combination of quantitative tests and qualitative review, and really starting to focus on the absolute quantum of pay. It's hard to say at what level of pay is going to trigger the ISS feedback that it's just too much and get an against recommendation. We did some analysis looking at this a while back. It was in 2019, but you see a company with a CEO pay with a 2 handle, 20 million. They could get a 4, they could get it against. You start seeing companies that start paying in the $30 million plus range. You start seeing more ISS against recommendations. And if we think about some of the recent pay package announcements, there's been some that are quite a bit above 30 million. So, as I said, this might be a decade where we see the quantum of pay get more attention, even if all the right boxes, if you will, from the ISS perspective are checked and performance is really spectacular. You could still get an against recommendation if the quantity is just too high. The other thing, despite those pressures, what we're expecting in the near term is that executive pay will continue to increase modestly. As we said, we think CEO pay is going to tick up here in 2019 when the 2020 proxies are disclosed. And as companies are sitting down, at this time of year, thinking about what 2020 pay levels will be, they're going to increase pay levels in general. Not across the board, of course, but we're expecting to see levels increase modestly. And then in terms of shareholder primacy, it's not dead. But we expect to see, as Dan just mentioned, we see more and are hearing more discussion about what the role of ESG metrics are, and the consideration of other stakeholders will be more prominent in companies' thinking over time. We do expect that there may be some increase in the use of ESG metrics, but even when used, they're going to have a relatively small weighting. Again, that may be 10% of the total scorecard. It may be 15% of the total scorecard, but it's not going to be a dominant factor like financial performance metrics are currently in the annual incentive plans. We expect, this is not, I don't think this is one that's not very surprising perhaps, but investments in socially responsible assets will continue to grow. But the question remains really, how far are the large investors going to go beyond divesting sort of the coal and oil and those sort of things? How are they really going to divest away from companies that are, and what is the scale there, and how are they going to evaluate what's a green investment and what's a green and not? In terms of what we expect, as there's increased emphasis on sustainability, we expect, as I said, we expect to see companies disclose in their proxy the highlights of their of their environmental efforts. On the topic of clawbacks, I think it's safe to say, at least in the near term, that clawback policies are really only going to move in one direction, and that is towards more expansive definitions of the circumstances under which companies can recoup pay. We think, again, after many, couple of years of at least of considering this, that 2020 might be the year where we see an increase in the prevalence of companies that are disclosing expanded clawback policies. And then finally, it's been continuing for a couple of years. We have the issue of income inequality. That's still a topic that is highlighted. And this year, we're going to combine that with an election season. And so what we think that's going to do is place executive versus employee pay in a bit more of a spotlight than it may have been even in the last couple of years. So those are kind of the things that we're seeing and we're thinking about, and we're having discussions with our clients in both the committee and in the meeting rooms.